Good afternoon, everyone. This is T3 Live Editor-in-Chief John Darsie here to bring you the daily recap. A few minutes early. It's almost 3:30 here on the East Coast. Looking to wrap up trading for the week, for the quarter, for the first 6 months of 2013. And what a really eventful 6 months it has been for this year. A lot of really exciting stuff going on, both more recently from a bearish side and for most of the year from a bullish side. It's been a year that has divided opinion. You know, you've had a melt-up type of action that we've seen obviously for most of the year, that for intraday short-term traders there's been some frustration because there's been not a lot of pullbacks and volatility that was buyable and tradable. But you know, if you're sitting long several positions over long periods of time, obviously you've been doing pretty well. But you know, I won't really touch on a lot of that macro theme of 2013 so far. We still have some year left, and there'll be a time and a place for that. But I'll talk a little bit more about the action that we're seeing today into this quarter and what maybe to expect the beginning of next quarter. And we've seen a little bit of a shakeup in the market. We see some interesting setups taking place in individual stocks. But we'll go ahead and take a look at the chart of the spiders. I'll try to be concise here with my message today. And something I talked about on Twitter the last few days is that we've seen a lot of talk about window dressing, and is this just a window dressing snapback and all that type of stuff. And it's hard to know how much emphasis to place on concepts like window dressing. I got all Scott's lines to contend with here. Whatever, we'll just leave them. Anyways, we've had these gap ups, and what I called it yesterday in the daily recap, I called them gap and nap. You know, you have terms that you know really well. There's a gap and go when you gap up and the market doesn't look back, and then you have gap and crap when the market gaps up, gives back all those gains, and then you have the phrase that I coined, which is gap and nap, and that's what you've had the last few sessions. If you look at the chart. And what that does is, yes, it has brought us back and erased a lot of these gains that we had last week. But when there's no power during the session, it doesn't lend itself to you having a lot of conviction about the market continuing to the upside. And you know, I'm sort of caught in two frames of mind right now, because I do think from a fundamental macro anecdotal standpoint that the market has overreacted a little bit to what the Fed announced. I know there's the whole Chinese credit crisis issue, credit crunch issue that is obviously weighing heavily on the minds of investors and things like that. But I think a lot of the sell-off was due to what the Federal Reserve said, which was basically nothing really different than what they've been saying all along, is that yes, they're going to tie all of their decisions to what happens to the economy, the job growth, inflation expectations, and things like that. And we've seen economic data pick up a little bit to the point where the Fed says, yes, if we continue on this trajectory, we will probably end up paring down QE by September or December, which is an obvious thing they have to do. They were always going to have to pump on the brakes, and they're trying to do it in a responsible and slower manner in order not to create a big shock for the market the day they do pull out. So this was an obvious step for them to take. They're still tying everything they do to the economy. So if economic data does start to deteriorate and we don't get the momentum that we've had, they probably will backtrack. They'll probably say, you know what, QE tapering is not a good idea, or maybe even we'll increase our QE, which a few of the more dovish Fed governors have taken that stance recently, that we stand ready to do anything. You know, we're flexible. We'll increase QE, we'll decrease QE, we'll raise rates, we'll do whatever we have to do depending on the conditions. So the market's reaction was basically that QE's over. All that stuff is done with. The market's going to have to live on its own and breathe on its own. We're going to take it off ICU. And that's really not the reality of the situation. And you saw a big sell-off in bonds. You saw a big sell-off in the precious metals, which I think was an inevitable thing. But in general, I think the reaction was a little bit too harsh to that news. The down move was a little bit too harsh, but you have to respect the price action, and supply and demand is what ultimately moves the market and moves stocks. And so the thing where I'm talking about where I'm caught in two minds, I'm saying there's been an overreaction, so I think the market might bounce, but the action, these gap and nap type scenarios where the market gaps up and has no power during the session, that doesn't lead me to believe that there's a lot of credibility in this bounce. You have window dressing potential and all that type of stuff. It'll be very interesting to see what happens next week, especially as we start to get more concrete economic data. The first jobs report after this QE tapering talk will be very interesting. I've written on our site about how much more important economic data is going to be now as a result of the fact that the Fed has sort of said, okay, market, economy, you're on your own a little bit. We're going to start taking the training wheels off. So all that economic data is going to be even more magnified, going to be even more in the spotlight. And I've talked about it also, is that if the data is too good, it might be perceived that it's going to hasten the Fed's exit from QE. If the data is too bad, everyone's going to say, oh gosh, this is a disaster. They've done all this QE and it still hasn't been able to help the economy gain any steam. So what we're going to be looking for, I think, is a number that's right around the expectations, so we can manage the expectations of investors while also not perceiving it as hastening the Fed's exit from QE. But those are just some macro thoughts. So I hate to be someone who stands up here and waffles and says there's some bearish signals or some bullish signals. So sit on your hands, light on your feet, yada, 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 all that crap when people, they talk about that type of stuff and talk in that way when they don't really know what the heck is going on, which, how does that help you if somebody stands up here and says, I don't know what's going to happen, don't do anything. That doesn't help you a ton, but there are select times when you really do have to take that approach. And I think now you really have to wait and see what happens at the beginning of next quarter, the start of next quarter, and maybe even wait till that next jobs report, because it is summer trading also. So some of the moves you're going to get, the market's going to twist in the wind a little bit with lighter volume, less volatility, things like that. So like I said, I hate to be that guy, but don't really have a strong opinion right now either way. And in that vein, I'm not going to make big bets in either direction. So enough of that rant. I will continue on with some ETFs and some stocks. We'll take a look at gold. I mentioned that. I've never really been in that gold bug, fearmonger camp, the zero hedge crowd, all these bearish blogs and people talking about, the world's going to end, and when the world ends, you just need gold. That's all you need. It's the only store of value. I'm not really been in that camp, so I've been bearish on gold as the Fed, exits QE. QE is the main price driver for gold, and with the Fed backtracking on that program, obviously it's going to be extremely bearish for gold. And you've seen really heavy selling in gold over the last few weeks after it broke that 130.50 floodgate floor support level, whatever you want to call it. The third time it gets there, I'm more inclined to call it a floodgate than I am a support level, because triple bottoms are somewhat rare, and you don't often see that pattern play out. But today we actually saw a little bit of a snapback in the precious metals. So I think we've seen some short covering and also some dip buying, and just the nature of a really oversold security like this. Silver's been even more impressive. We're looking at GLD right now. Looks like it's going to erase all of yesterday's gains pretty much after an initial drop this morning sort of was that final flush. Take a look at a ETF like SLV, even outperformed gold, has closed that gap from earlier in the week. I'm going to say it again, much more impressive than gold. It has some industrial uses. Maybe people are pointing to that as a reason for its relative strength within the precious metal sector or group. But a lot of volatility right now in these groups, and if you're a short-term trader, you feel like you're skilled, and you feel like you can take advantage of things like this, be my guest, trade these things, but it's also a very dangerous game to play. Over the long term, I don't think that's the best way to be successful, but to each his own, I guess. We'll take a look at BlackBerry today, down huge on a absolutely horrendous earnings report. Now, the company was expected to potentially lose a little bit of money, but they announced a massive loss, and obviously the results have been in keeping with that really, really poor news. The stock has been down almost 30% for much of the day. It's I think it's around 25% down now. I'm not sure why it's not showing the gap down. I'm on a daily chart, but anyways, really weak action in BlackBerry. You can zoom out and get a better look at, we even go to the monthly just to laugh at BlackBerry, for lack of a better way of putting it. The stock is at $140 a share. Everybody's at work pecking away on their BlackBerries. BlackBerry's the phone to have. Everybody's kids, they go to college, they want a new BlackBerry so they can be cool with their friends. And then you get a monster move down, and the company hasn't really been able to find its footing since then. And you zoom in on this little range here. It's sort of a little wedge pattern that I see someone drew. We'll just go back to the daily chart to show it, and obviously kerplunk there for BlackBerry. And the only real catalyst I see and rationale you could have for buying BlackBerry besides just day trading it and looking for really transitory bounces is the idea of a takeover or the company divesting parts of its businesses. It's all the contracts it has and stuff like that. Like the hardware business has done really poorly, but they do have some intrinsic value in certain parts of their business that if they do start talking about spinning those off, maybe there's some value in there and you could see the stock spike. But there's nothing really compelling here from a dip buying perspective for me, as the company looks headed for bankruptcy, to be quite frank about it. we'll take a look at Apple. This is one sort of like gold and silver. Gotta get to my chart here. Sort of like gold and silver, it's been an absolute dog. It's been showing consistent relative weakness. We have all Scott's lines or somebody's lines in here going crazy with their lines, but I think they're overcomplicating things actually with all these lines. But I think basically with Apple, all you need to know is that days when the market bounces, Apple's continue to sell off. And when a market or a stock doesn't bounce when it's supposed to, I don't think it's something that you should have a ton of interest in being involved in. Today, yes, a nice compelling bottoming signal in Apple, but I would be much more inclined to buy on strength and then a base in Apple than I would be to try to catch bottoms. And that's my perspective in general, is catching bottoms. Yeah, you can get some really good entries, get some really good prices, but I'm much more inclined to wait for a stock to settle out a little bit, create a base, and give you some calculated entry areas, and wait for so the sentiment on it to pick up a little bit. And right now, yeah, Apple, nice move today, could lead to some short-term upside, but still below all of its moving averages. No real products that seem close in the pipeline that could be a big catalyst for it. So if that type of stuff starts coming through, maybe it's a different story. But Apple, if somebody keeps talking about it, I would just ignore them because it's not worth your time. SolarCity, a setup I really, really like. Really big short float like its cousin Tesla. They're cousins because their daddy's Elon Musk, or he's the chairman of the board of SolarCity. He's not the CEO. Tesla, obviously SolarCity benefited a lot from that Tesla hype, as it traded all the way up here above $50. It came back to earth heading into that IPO lockup expiration, which happened right around here, June 10th, 11th area. But it's absorbed that now. It didn't really get the big breakdown that a lot of people expected. I mean, the fundamentals on the company aren't there, even close to there yet, but they had that news a couple days ago about the partnership with Walmart, where they're going to be installing solar panels on Walmart stores and generating 20% of electricity for a lot of these Walmart stores. That could be a relationship that bears a lot of fruit for SolarCity into the future and could be a template for the type of relationships that are going to make SolarCity successful. So that triggered, I think, an 8 to 12% move higher in the stock. I can't remember the exact figure, but you go back to the chart, you can see that bar right here. Really impressive move. It sort of helps SolarCity get back on track. And then if we can get back above this $40 area, I really think you could see some momentum come back in. A lot of it will probably be short covering because you still have that big short float in SolarCity. But, I think this could be poised for a big momentum move. It's not one that I would buy right now and put it in the drawer. I don't believe in the fundamental story well enough to have that perspective on it. But if you're looking to swing trade it, short-term trade it, I think it could be a really good opportunity, one you should definitely be watching going forward. XONE, another one like that the fundamentals of 3D printing and all that type of stuff, I don't really buy into it. You've seen XONE's pull well off its highs today, but in general, it's been extremely strong. One that we've highlighted in our Off the Charts newsletter several times on a breakout from this level, and it's extended really nicely. Steve LeVay in the Momentum chat room focuses on it really heavily. He wrote an article on our blog yesterday about that. The title was, "If it ain't broke, don't fix it." And his point was basically that he's having a lot of success trading XONE, so he's not going to be distracted by all these other symbols that everyone's talking about while there's still this cash cow for him or a land of opportunity. He's going to focus really heavily on one stock if it continues to move and provide opportunity, and that's what XONE has been doing in both directions. You want a vehicle that when you're a day trader, when you're a short-term guy, and that's not what I am, just to make it very clear to everyone, but when you are that guy, you want a vehicle that you can play on both sides. You can buy it at strategic areas, you can short it, you can really just get a feel for that stock and develop gut instincts for what that stock's going to do based on certain setups. And I feel like Steve has been able to do that really well with XONE. So if you're interested in trading this type of vehicle, in terms of putting it in the drawer, like I said, I don't buy into the fundamentals of 3D printing and XONE at these levels. But if you're a short-term guy, you'd be doing yourself a disservice not to pay attention to Steve and not to be paying attention to XONE. So there's that. Wells Fargo, we talk about the banks a lot. Wells Fargo is not one that we talk about, or at least Scott talks about it as much because it's a lower beta name. He's more of a short-term guy than I am. I take more of a long-term perspective, and from a risk-reward long-term perspective, Wells Fargo has the best and most attractive profile in my mind because the company is a lot lower risk company. They don't take the outsized risk that a lot of these other banks do. As a result, the stock is lower beta, doesn't move as much relative to the market, but it's shown really great relative strength over the last couple of months. It held in the upper level base during all that market turmoil. Anytime the market did bounce or at least stagnate and find its footing, you saw Wells Fargo trading back to the upper end of the range. And today it was weak early, but it's come back and paired all those early losses and looks like it's poised for a breakout. It's not going to be an explosive Tesla, SolarCity, short squeeze type move, but a stock with a nice dividend yield, a nice pattern, really sound fundamentals. I love to put a stock like this in the drawer and sleep well at night and not have to worry about all the other stuff that goes along with day trading. And the last thing I will talk about today is Noodles and Company. Some people are calling it the baby Chipotle. It's a new IPO today. If it'll come up here. Not really shown very well here. I don't know what's going on with my charts, but Noodles and Company open for trading today around 32, I believe. I don't know why this chart's not working for me. There we go. We'll go to the 55-minute chart. We can see it better. Noodles and Company, new IPO, compelling story, sort of like Chipotle was before it got spun off from McDonald's, and even after that, they're growing their revenues a ton and opening new franchises, and it's, everything's sound with the company fundamentally, and people love the growth story. And this one opened up for trading much higher than the IPO price. I can't remember the exact range on it, but as you can see, it opened for trading at 32. Initially spiked all the way up to 37.50. Obviously, huge interest from the open market in this IPO, and it's bounced back and forth from highs and bounced around during the day, but it's continued to march higher and responded to every one of those dips with renewed buying interest. So this, I'm sure, will be one that is on traders' radars going forward because it's going to have volatility. It's, sometimes we say that some of the biggest winners long term even come from new IPOs, and so you got to watch really the action right after the IPO to get a gauge for oftentimes what the profile of that stock's going to be going forward for a long period of time. So Noodles and Company, if it can continue higher, perhaps build another base, this could be one that becomes a really hot stock in the market over the next few months to next few years even. So that's about it. That's all that really stood out to me in the market today. Great quarter for the market, great quarter for the market, decent quarter for the market. Didn't close it that well. Great 6 months for the market. The second half of the year should be really, really interesting as the Fed changes its rhetoric a little bit and everything that comes along with that. The precious metals will continue to be very in focus as they're very sensitive to Fed and other central bank news. So that'll be a theme to watch really closely. And bonds will be interesting to watch, see if bonds get a snapback. Now we'll take a look at the TLT. You know what? I think it's very important to always watch the bond market. We'll go to the daily chart. TLT, I've been expecting a snapback in the TLT, frankly. Like I said, I think that old QE tapering narrative is overdone. It was an overreaction to it, especially in the bond market. So I think, in my opinion, you'll continue to see a snapback in bonds. That sort of goes contradictory to some of Scott's opinions about the head and shoulders pattern in the TLT and this and that. But I'm not as pure a technician as I am someone who combines a lot of different perspectives. And yeah, I obey technicals, and I think they're a very powerful tool. But I think the bond market right now saw a little bit of an overreaction. That overreaction, yeah, it could be evidence of a big mindset shift among bond funds and things like that. But I think you'll see a snap, as we saw today, you'll see a snapback in the TLT. That's my opinion. So I don't think you chase lower prices in bonds and stuff like that. I don't think you put TBT in the drawer yet, and you don't put TBT in the drawer in general because it's a leverage bearish ETF, and you have a roll down and rebalancing that eats into your returns over the long term if you hold an instrument like TBT long for a long period of time. Just like with VIX, the VXX is a horribly demented. Demented is not the right word. It's completely out of whack. It doesn't track the VIX very well, and it's built to go to zero because of the nature of these leveraged ETFs. But enough ranting there. I'll leave you guys. This was supposed to be a short daily recap, but I always get up here and want to hear myself talk. So I'll call it a day, and everyone have a good weekend, and we'll get after it third quarter 2013. Have a good one.
I'm Evan Lazarus, Chief Knowledge Officer for T3Live.com. You don't become a great trader by watching videos and taking courses. You become a great trader through live screen time. Accelerate that learning curve by tapping into the experience of seasoned professionals. Currently, we're offering 5-day free trials to each of our 4 mentoring rooms. In the mentoring rooms, we teach our strategies in the context of the live market. To sign up for a free trial, go to the T3 Live education page, fill out the form, and get started when the next trading session begins. We hope to see you in one of our mentoring rooms.